Buying a car used to be a simple financial decision. You found a car you could afford, negotiated the price, made your payments, and eventually owned it. But in 2026, the way Americans finance cars has changed. Cars are more expensive, loan terms are longer, monthly payments can look manageable even when the total cost is enormous, and many buyers focus on one number, the monthly payment, while ignoring the number that matters most, how much the car will actually cost them. That is where the car loan trap begins.
Welcome to the Fiscal Diet.
You might think you're buying transportation, but if you're not careful, you could be buying years of debt, thousands of dollars in interest, and a financial obligation that follows you long after the excitement of the new car disappears. The monthly payment trap. Imagine you walk into a dealership and find a car priced at $35,000. You tell the salesperson you want to keep your payment around $500 a month. Instead of negotiating the total price, the conversation quickly becomes about the monthly payment. The dealer may be able to make that payment look affordable. How? By extending the loan. A 6-year loan can become a 7-year loan. The payment gets smaller, but you stay in debt longer and potentially pay much more interest. This is one of the biggest mistakes car buyers make. A $500 payment doesn't necessarily mean you can afford the car. The real question is, how much will this car cost me from the day I buy it until the day I finally pay it off? The long loan problem. Longer car loans have become increasingly common because they make expensive vehicles easier to finance. But there is a hidden cost. The longer you borrow, the longer your money is tied up. Suppose you finance a car for 7 years. That's 84 monthly payments. For 7 years, a portion of every paycheck is already committed to a vehicle you bought years earlier. And there's another problem. Cars generally lose value over time. That means your loan balance can remain high while the market value of your vehicle falls. This creates something called negative equity. In simple terms, you owe more on the car than the car is worth. And negative equity can become a serious financial problem. When your car is worth less than you owe. Let's say you buy a $35,000 vehicle. A few years later, you still owe $27,000. But the car is now worth only $22,000. You're $5,000 underwater. Now imagine you want to trade that car for another vehicle. You still have to deal with that $5,000 difference. Sometimes that debt gets rolled into the next auto loan. Now you're not just financing your new car, you're financing part of your old car too. And that's how people can end up paying for one vehicle while driving another. The cycle continues. Old debt gets added to new debt, the new loan becomes larger, and the next monthly payment gets even harder to escape. The trade-in illusion. Trade-ins can make this problem harder to see. A dealership might offer you what sounds like a generous amount for your old vehicle. But what really matters is the difference between what the car is worth and what you still owe. If your car is worth $20,000 and you owe $25,000, you don't really have a $20,000 trade-in. You have negative equity. That $5,000 difference has to go somewhere. And if it's rolled into your next loan, you're starting your next vehicle purchase $5,000 behind. Don't let a trade-in number distract you from the bigger picture, the add-on trap. Then there's another part of the car buying process that can quietly increase the cost. Add-ons, extended warranties, paint protection, fabric protection, security systems, service packages, gap coverage, accessories. Some of these products can be useful in certain situations. The problem isn't that every add-on is bad. The problem is buying products you don't understand, don't need, or didn't plan for, and then financing them along with the car. A $2,000 add-on doesn't feel like $2,000 when it's buried inside a multi-year loan. It may look like just a few extra dollars per month, but you're still paying for it, and potentially paying interest on it. That's why you should always ask for the total out-the-door price before agreeing to anything, the hidden cost of the car. And here's something many buyers forget. Your car payment isn't the actual cost of owning your car. You also have insurance, fuel or charging costs, maintenance, tires, repairs, registration, taxes, parking, and depreciation. Depreciation is especially important because it isn't a monthly bill you see leaving your bank account. But your vehicle can lose thousands of dollars in value over time. That's real money. So when you're deciding whether you can afford a $600 car payment, don't ask only whether you can make the $600 payment. Ask whether you can comfortably afford the entire cost of owning that vehicle, because a car that fits your payment budget may not fit your life budget. The "I deserve it" trap. There's also a psychological side to car buying. You work hard. You see your friends driving newer vehicles. You see advertisements showing luxury cars and low monthly payments, and eventually upgrading your car can feel like a reward. There's nothing wrong with enjoying your money, but a car is one of the easiest purchases to turn into an emotional decision. You test drive it. You like the technology. You like the seats. You like the feeling of driving something new. And suddenly the question changes from, is this a smart financial decision? To, how can I make this payment work? That's a dangerous shift. Because once you've decided that you want the car, it's much easier to justify the loan. The interest problem. Remember, when you finance a car, you're not just paying for the vehicle, you're borrowing money to buy it. And borrowing money costs money. Your interest rate, loan amount, and loan length all affect the final amount you pay. A longer loan can mean more interest over the life of the loan, even if the monthly payment looks attractive. That's why two people can buy similar cars, but end up paying dramatically different amounts. So how do you escape the car loan trap? First, set your budget before you visit the dealership. Not after. Decide what you can comfortably spend before someone tries to sell you a car. Second, focus on the total price, not just the monthly payment. Ask for the out-the-door price. That means the actual amount you're expected to pay, including applicable taxes, fees, and other charges. Third, compare financing options. Don't automatically assume the dealership has the best loan available. Check your options before you shop. Knowing what financing you qualify for gives you more negotiating power. Fourth, consider buying a reliable used vehicle instead of automatically choosing a brand new one. A newer car can be great, but new doesn't automatically mean financially better. Sometimes the smartest car is simply the one that gets you where you need to go without taking a huge bite out of your income. Fifth, avoid rolling negative equity into your next vehicle whenever possible. If you owe more than your current car is worth, understand exactly how much that gap is before making another purchase. And sixth, don't let a salesperson rush you. A car is a major financial decision. You don't have to make it in 10 minutes. Take the numbers home. Read the contract. Look at the interest rate. Look at the loan length. Look at the total amount you'll pay. And if the numbers don't make sense, walk away. The best car may be the one you don't need to finance. Here's the uncomfortable truth. Americans don't necessarily get into financial trouble because they buy cars. They get into trouble when the car becomes more important than their overall financial health. If a vehicle payment prevents you from building an emergency fund, paying down high-interest debt, investing for retirement, or saving for a home, the car may be costing you far more than its sticker price. Your vehicle should serve your financial life, not control it, because that shiny new car in your driveway might feel like a symbol of success. But true financial progress is having enough money left over after the payment to build your future. So before you sign your next auto loan, remember 3 numbers: the price of the car, the total cost of the loan, and the amount of money that car will take away from your future, because the most expensive car isn't always the one with the highest sticker price. Sometimes it's the one that keeps you making payments long after the excitement of buying it is gone. And in 2026, avoiding that trap could save you thousands of dollars and potentially put you years ahead financially.